We're now proceeding with our next panel. We started with a panel on the Greek banking system and financial services. We had a presentation on the new proposal by the Bank of Greece on NPLs. And now we have our panel that will focus on the NPL issue. We have a great panel with us, comprised of major participants in this industry, in this sector, both as investors and also as servicers and market participants. I will turn it over. To Mr. Potamitis, the managing partner of Potamitisvekris, who is going to moderate the panel, and he's going to introduce the panelists. Thank you to all for being with us.
Thank you, Nico. My name is Stathis Potamitis, and it's my great pleasure to moderate the panel on the NPL market. We have a truly stellar panel, and I'll introduce them in a moment. The panel will focus on a few critical issues relating to the NPL progress and outlook, ways to improve the market, the experience of investors, and their expectations. One significant recent change in our framework is that is likely to impact the NPL market is the introduction, effective as of the coming year, of a new streamlined insolvency framework. The new framework is expected to speed up recoveries and create greater predictability as to outcomes. We will also look at the real estate market and on the anticipated impact on the NPLs, on secured NPLs specifically. The panel will also discuss the experience of investors to date and investment opportunities in Greek NPLs going forward. We will also discuss ways to deal with liquidity needs of the market and various ways to do that. We will focus on 5 topics, starting with Georgakopoulos on the impact of the new insolvency framework. Of course, the rest of the panel will share their views as well. George is the managing director of Intrum Hellas and a member of the group management team of Intrum. And previously, he served as an executive board member of Piraeus Bank. George.
Stathis, thank you. Good afternoon to everybody in the audience, and thank you for making the time to join in. Look, I think it is one of the big rare successes, this new piece of legislation that we have in our market regarding insolvency. I think I would describe it simply as a very big step forward for the market and a significant, to start with, a significant structural reform. Interestingly, I think it is benefiting all participants in the market. First of all, the broader economy to start with, and I will explain why. Debtors, creditors, and investors. And let me say a bit more why I'm so positive about it, and as a practitioner now in the NPL market in particular. Now, first of all, regarding the broader economy, the big thing about the new piece of legislation is that it is holistically dealing with private debt. It is dealing with and abolishing a number of dated pieces of legislation. It's giving us a clean view and a clean state of affairs on how we can move forward. It's introducing a number of, I think, innovative tools like out-of-court settlements, and the same for preventive purposes, which I think is eventually a very, very good thing for the market. Is introducing a number of tools that give speed and shorter deadlines, is enhancing market transparency, is introducing in a number of ways flexibility. And interestingly and importantly, it is opening the economy and redirecting productive investments where they should be, or it is facilitating the channeling of productive investments where it makes most sense. It's dealing finally, I think, with the so-called zombie companies rather effectively, or giving the tools for us to deal with them rather effectively. which should act as a catalyst and rejuvenator for the whole market. Practically now, speaking about debtors, about investors, about creditors, regarding creditors, I think this is where the biggest steps forward probably are taking place. First of all, is giving a clear and true second chance to debtors, to borrowers. Because at the end of the day, they can take the right steps, go through the procedure, and change the page, do a new, fresh start without the baggage of the old debt that would follow them otherwise in a rather disproportionate manner. Simply the very fact that they do not have the debt necessarily following them forever, and they can get rid of it in an organized fashion through a clear and transparent process is a very, very positive tool for debtors. At the same time, is addressing, I think, in the very right way, the issue of protection of the vulnerable. We would all agree that we need the vulnerable segments of the population to be protected. And what I think the law does very well is protecting them in the right way. Specifically, what it does is it allocates state subsidies to protect the right to live in a property, which is actually the right that indeed the law should be protected, but not the right to ownership. So at the same time, it's protecting the rights of the creditors. It helps the market to continue functioning, but it is effectively protecting, as it should, vulnerable population. And this is through the mechanism of an entity buying at auctions assets of vulnerable, distressed borrowers. Coming now to the creditors, it will be, I think, a whole new world for creditors, because, you know, practically many more tools, even more so, by the way, in cases of corporate debt, in the hands of creditors who can, out of the court in the first place, be able to offer viable solutions in a fast, efficient manner. But if this does not work, the creditors can move much faster to recovery and tackle very effectively, I think, with new tools, for example, access, lifting of banking secrecy and fiscal situations, tackle effectively strategic defaulters. So really new tools and for the creditors. As far as investors now are concerned, and I would say, you know, two different types of investors. Let's say investors, first of all, in NPLs. Certainly the benefit from all I described earlier regarding the new tools in the hands of creditors. So better tools for faster recoveries and better and more reliable returns. But I think there will be a new type of investor who may well benefit from the new law regarding second chance and bankruptcy framework. And this is equity investors, because we think that the new framework will facilitate consolidation in the market, a well-known ill and weakness of the Greek economy and the Greek market structure, which of course will need fresh new capital and significant opportunities to new equity investors. At the same time, if you see the state a bit as an investor in the new securitizations, because the state is providing a state guarantee for the securitizations, the state will benefit because it has all the advantages in reality and all the economic benefits a creditor may have, and therefore I think as an implicit investor in those securitizations would have a benefit as well. The only thing is not going to be plain sailing. It is demanding to go and reach the implementation. It is a very complex piece of work between now and implementation. Gives me, though, quite a bit of positive aspect and quite a bit of confidence that we are going to be successful. I see the Ministry of Finance and the Minister of Finance himself committed to drive it through and deliver it. And from what I know, all the market participants really willing to work hard on it. If there is a soft deadline to implement it, which is before Easter. This may be a bit ambitious, but I think we need a bit of ambition to drive a significant structural reform like this one forward. So indeed, I'm very positive, but practically recognize that we have the last mile to get to the end of it.
Thank you very much, George. Do others want to comment, please?
I think, Stathis, if somebody were to make a comment, that would be you.
I have to admit I'm extremely biased, having contributed to it. But I'm delighted to hear what George has to say, because I also share his sense that this is a very significant structural reform, and I expect it's going to help the market a lot, especially the market in loans. Okay, well, on that note, perhaps Costa, we can turn to you on the real estate angle. Kostas Karagiannis brings 23 years of professional experience in finance. He is currently an operating partner of Apollo, covering private equity, credit, and real estate investments. So on to you, Costa.
Thank you, Stathis. And it's I want to express my appreciation for being here today. So the real estate market in the context of the NPLs, that's, I'm not going to say this is $1 million question, but that's a big elephant in the room. So let me begin by saying that 2020 has not been the landmark year for the Greek NPL market that everyone was expecting at the end of 2019. At the end of 2019, we had a resilient real estate market, and the conditions were extremely favorable for the further deleveraging of the banks in NPLs, mainly through sales and the securitization schemes that are taking place. In 2019, Greece had experienced the highest inflow of foreign direct investment since 2000, approximately 1.2 billion euros in real estate investments just in 2019. While the market was, had found a very positive momentum, we experienced a compression of headline gross yields for prime commercial real estate assets to range between 6.5% and 8%, which embedded price increases of 10 to 15%. That was at the end of 2019. And that's exactly the point when the COVID pandemic hit, with the subsequent very sharp recession, which is very likely to create a new generation of NPLs and has already resulted in the flattening of real estate prices and a much softer real estate market, at least so far, which, it's a vicious circle that in turn impairs the reduction of NPLs by the banks. It's a catch-22 type of thing. What we've experienced so far in 2020 is a limited activity in terms of transaction. My best guess, my best estimate, it's not a guess, is that the transaction volumes have been anywhere between 500 to 700 million euros, including involving mainly the conclusion of deals that were at an advanced stage. While in terms of market dynamics, I will just indicatively say that tenant-related problems have resulted in lease renegotiations at lower levels, as expected, and transaction yields have picked up. So that's a snapshot of the market. Now, if somebody were to ask, what is to expect going forward, I don't think there is an answer that fits all, as dynamics significantly differ among the various real estate market sectors. Take the office sector, for example. Pre-pandemic, people may have felt slighted in the suggestion of a video conference rather than to a face-to-face meeting. Post-COVID, people will assess whether a business meeting is necessary at all, or if the same objective can be achieved virtually. In this direction, we've entered a new era. In this direction, we will be going into the office less often, and companies will look at real estate differently. while office space will need to be redesigned. For example, we can expect office share schemes between companies where two companies share the same space by letting their employees come in on different days of the week. One would think, isn't that a threat for the office segment of the market? Yeah, this couldn't be perceived as a threat, but the fact that there is rising employment in other sectors, such as e-commerce or cyber IT security, may in fact increase the demand for office space, especially in the Greek situation, where the supply of stock is very limited. There's not enough stock of, grade A office buildings around, and there is no new construction, at least in the near term. Having said all that, I think all these facts are supportive that to the fact that to the potential that the office sector will bounce back swiftly post-COVID. On the other hand, the shift from retail to e-commerce has already increased the demand for warehouse space and logistics. These are the star performers, logistics apps. These are the star performers of the real estate market this year. And this could drive the repurposing of existing retail networks or ancillary buildings. In other words, owners will start thinking, do I really have use for this as a retail space, or could I reconvert it, repurpose it to something else to support an e-commerce activity? This is something we're going to be dealing with, not just in Greece, but everywhere in Europe and the US. So the shift to e-commerce and the national lockdowns have seriously impacted the retail sector. Recovery prospects in the immediate term are weak, they're bleak, and they would need to be assessed within the new social context that is emerging from the pandemic. The hospitality sector, I'm just trying to focus on the three main sectors of commercial real estate: office, retail, and hospitality. Hospitality is a case on its own. While it has indeed been severely impacted, it certainly has the potential for a rapid turnaround as return to normalcy is gradually achieved with all the vaccination programs. Most likely 2022 onwards. I don't think we're going to see many exciting things in 2021. However, I have to say that the investor community is reflecting on the new shape that things are taking. For example, it is very likely that there will be high demand for exclusive type of secluded hotel properties away from the mass tourism, one size fits all, traditional, holiday spots that we've seen in the past. In this direction, hotel properties would need to be repositioned, rebranded, and there's going to be CapEx investments that will be required. So is there going to be a rush in hotel investments? It's not going to be a rush. It's going to be very carefully reviewed, but the market is very much there. So we should expect activity. Let me conclude by drawing from the Chinese language, where the word crisis has two letters. One signifying danger and the other signifying opportunity. This crisis, this COVID-19 crisis, especially in the Greek market, only magnifies the opportunities that exist in the market. What we're looking at here is a market that is coming out of a prolonged 10-year crisis with price levels, even at the end of 2019, take away the soft factors of this year, price levels well below their historical highs, and most importantly, substantial disparities in comparison to other European markets. This type of disparities, this type of dislocation certainly have caught the eye of international institutional investors. And as much as they're looking at other markets, I think Greece will very much stay in focus for the international investor community.
Thank you very much, Costa. In the interest of time, perhaps we can move now to Chris Linkas to speak about the experience of investors. We already have one question, but perhaps we'll save it for the end. Chris is the co-head of European Credit at Fortress, as well as the co-head of European NPL strategy at Fortress. He's a Greek American based in London, Chris, it's up to you.
Thank you, Stathis. Look, following Costa, I wanted to speak a little bit about what I see as the chief challenge really for Greece as it relates to NPLs, and that's the lack of liquidity in the real estate market. After the great financial crisis, and really I think up until COVID, we saw low volumes in the real estate market. We saw a lack of transactional data, and that's really difficult and provides challenges and barriers for foreign investors. We have no central land registry in Greece, and comparable information can be difficult to get, and it's in Greek. So these are difficult for foreign investors. On the other hand, in the NPL space, the e-auction platform for foreclosures is in place and functioning. It's not functioning precisely now with the COVID, but that aspect is working. And as we know, it splits the auction proceeds 65% to the secured, up to 25 for the super seniors and the government, and up to 10 for the unsecured. So that's in place. But what we need is we need more bidder activity on the far end of those auctions. And I looked recently at the 2019 auction data, and I just want to touch on it. In 2019, there were 23,000 auctions, and there were 1,200 which traded to third parties. So 23,000 auctions, 1,200 making their way into the hands of third parties who are paying cash. So 5%. 95% of the time, the bank is retaining the risk. So in addition to the 5%, another 25% the bank's taking onto its balance sheet as an REO, as a real estate owned. So a total of 30% that are effectively clearing in the auctions. That compares to about 75% in other countries like Spain and Italy. So the success rate here is just too low. There's not enough real bidder activity, and there's too many fruitless auctions. I know, picking up on what Costa said, in the months preceding COVID, there were some green shoots. There was buoyancy in the market. There was more investment activity. The sales volumes were up. We saw the prices up and rental activity up. And actually, the auction pace was up markedly in those months compared to the prior months. And there was also improvements in terms of advertising, broker network, efforts regarding the central cadastral information, and also legislation around illegal construction and what that means for investors, that type of thing. But I think when you cut through it, really what needs to happen in Greece, I think we need to get back to those months pre-COVID where investors are seeing other investors making money. That's what I saw in Spain in 2013 with the Sareb and in other countries. It's like priming the pump, and investors really take note. Foreign investors buying from domestics and vice versa, and it starts a snowball. That's what I think Greece needs to get back to. Lending begins to take shape. First opportunistic lending, and then specialty lending, and then eventually the banks getting back into the business, having cleaned up their NPLs. So that's my thought in terms of, what Greece needs to do to get back to investment.
Thank you very much, Chris. Theodoros Athanassopoulos, perhaps you want to address the question of liquidity more specifically. Theodoros has served as an executive general manager of Alpha Bank, and since this year he is also serving as the CEO of Cepal Hellas. Theodoros, your turn.
Thank you, Stathis. I think Chris touched upon the most important thing on resolving the NPLs, and this is liquidity. So in Greece, as we always say, we are running a marathon with NPLs, but structurally, we go to the services notion starting a few years ago, and only from last year we actually do have services in the market. We've seen portfolio sales actually taking place in the last 2 or 3 years, and what we see as NPL reduction so far is actually a deconsolidation from the bank's balance sheet, and we have not seen the resolution going forward. So for the resolution to start and for the problem to be resolved, which is a macro problem from Greece, we do need healthy and viable restrictions, but we do need the real estate market functioning, because NPL valuation and NPL resolution is linked 100% with the real estate market. And we also need to see liquidity in general in the market. I think Kostas, Karagiannis, and Chris can confirm that whenever an investor is building up a business plan to buy NPLs, he also looks at value, at real estate, but an investor always then embeds into his valuation, into his business plan, the ability of certain borrowers to be, after a few years, in a position to refinance investors out. And NPL investors, they do have different investment horizons than the banks. So what they offer in the market is expertise. They offer fair valuation, but investors usually require, or almost all the time required, accelerated payments. They might be in Greece for a longer term, but NPL funds, they do have a specific investment horizon. For this, bid-ask between borrowers, which is their ability to restructure their debt, and real estate investors, and timing bid-ask, as I call it, and NPL investors to close, we do need a functioning refinancing market. And in Greece, we do not have, apart from the real estate market, which we opt to pick up, we do not have a functioning refinancing market. So the next thing that we're going to be seeing in NPLs for the resolution to actually take place is someone who will gradually assist, either from the private equity industry, the same way that Mr. Karamouzis will be elaborating afterwards, or from challenger banks, the ability of third-party funds, the ability of borrowers who can repay the requested amount of debt from investors, but they need more time. We will be requiring to see this new liquidity coming to the market to close this timing asynchrony. The Hercules program, given that this is a leverage transaction, addresses that partially, but we also have other types of transactions that need this assistance. So I think liquidity in the market, in a concentrated from the banking system market, and liquid real estate market are the other ingredients that we need, on top of the structural reforms, on top of the new composition of the market from dedicated players, and following investors who are coming in. So last year we were talking, I remember George in the US announcing the transaction and the assumption of Intrum. This year we can talk about a functioning servicing market. I hope that next year we'll be talking that the other ingredient, which is liquidity, will also become in. If we have that, we will actually be seeing the true resolution, and which will follow the current status, which is the consolidation from the banking balance sheet, from the banking system balance sheet.
Okay.
Thank you, sir.
Thank you very much. Unless somebody has a comment to contribute at this point, we can move to Nikos Karamouzis. I understand he will be speaking about the prospects of the market and how to take advantage of current opportunities from an investor perspective. Nikos is very well known. He is the chairman of Grant Thornton and the executive chairman of SMERemediumCap. He has had a very distinguished career in the banking sector and indeed far beyond the banking sector. Nico, please take the floor.
Okay, can you hear me now?
Yes.
Okay, thank you very much, Stathis, for your good words. Last February, we concluded a group of colleagues we concluded the raising of 105 million euros to create the SMERemediumCap, which effectively is the first mid-cap turnaround fund in Greece. We focus on mid-sized companies with turnover between 10 and 100 million euros. The average investment is between 5 and 15. And through our limited partners, we can participate in bigger deals. Effectively, we are looking to restructure and transform business and financially mid-cap companies that they're either over-leveraged, underperforming, or they have significant liquidity or capital problems. We are not a minority participant. We are aiming at acquiring control of those companies. This is a great opportunity in my view, because there are 3,500 NPE companies, non-performing exposures today in Greece, and between 35% still after all these years of the corporate portfolio is classifying the banking books as NPE. So it's a big chunk of money, and I think this is a big opportunity. We face a number of positive factors in our work to invest in this type of companies. I would go through very briefly. There are 7 positive factors. A, this is a wide universe. It's a historic, unique opportunity to select companies from a universe of 3,500 NPE companies. So you can select, we intend to make 7 to 10 investments with the money we have raised. So historically, it's a unique opportunity. COVID-19 is going to generate another 5 to 8 billion euros of corporate NPEs. There is enormous pressure on banks to clean their portfolios, and also there is a positive development that they transfer the management of NPEs to professional companies like my colleagues here, that at market terms. So there's better terms to negotiate and conclude a deal. There is a material improvement in the new insolvency framework, and Stathis was instrumental in drafting and promoting this law. And this would expect to speed up corporate recoveries and rehabilitation initiatives. There is a steady build-up of provisions in the banking system, which is bridges the gap between bid and offer prices when you try to price non-performing loans. There is the guarantees offered by the project Hercules on the senior component of securitization, which facilitates the securitization of NPEs and the transfer of management to professionals, which is, all things equal, is considered to be a better conditions to do a deal. You have more professional discussions in this case. Now, there are 9 negatives. Very quickly, COVID-19 lockdowns have made negotiations very difficult with all stakeholders. You cannot buy a company from the video. These are family companies, very sentimental. So our work has become very difficult, and it's very difficult to put all stakeholders together and try to get an agreement. So cooperation still is an issue. There is significant delays in courts, despite the recent improvement in the law that became effective January 1st. The recent restructuring took 2 years of a Northern Greece food company. Took 2 years to complete the restructuring. 2 years. I say that 3 times because it must be in the Guinness Book. Auctions, which is a pressuring machine, is being postponed until March, if I'm not mistaken. Unfortunately, in my view, I don't offend anyone, the price of collaterals in the banking books are inflated. My view, I hope I don't create any problem saying that, but this is my view. There is incredibly low, poor quality of corporate governance and financial accounting in the SME companies. And I hope soon the banks realize that this element must be one of the credit criteria. We cannot continue with this situation the things I have seen on the other side now, I've been shocked with the poor quality of the numbers. There are still some loopholes in the bankruptcy law that allows old owners to delay decisions and delay decisions. There is unrealistic expectations by the current corporate owners of non-performing or over-leveraged companies. Most of them, they feel they run Google, and so they expect that they would make a life payment by selling their company. And obviously the recent programs run by the government, supported by the government, provides a lot of liquidity even to NPE type companies and delays the rehabilitation and restructuring process. They feel they have another opportunity and another hope to keep their company and move on. Despite all this, the positives are very strong. I believe this is a unique opportunity. We are progressing despite the difficulties in several sectors: agribusiness, great opportunities, food, beverage, industrials, building materials, business services, transportation and logistics, tourism, and leisure. And I close, I'm reviewing now an investment in tourism. I've lost my list, whatever is left on my hair after I go the due diligence list, and I saw the hotel how was operating for environmental requirements, to licensing the land, to whatever. I was hours, and then I tried to do a pill to relax because it was really amazing. It's an incredible situation. It takes, and I close with that, 22 documents to transfer property today in Greece. 22 documents. It's an amazing thing. Thank you very much, and I'm open to questions.
Thank you very much, Nico, for this very lively presentation. From what I see, we have one pending question. We have 2 minutes to go. And the question is very general, and it is the NPL market here to stay? Do we have a reply to that?
I think if I may say, the NPL market is here to stay for quite some time, for the very simple reason I think my colleague Theodoros Athanassopoulos described before. The reality is that the NPLs in the billions and billions and tens of billions have been and are being deconsolidated from the banks, but they stay out there in the economy. So we need to reach a resolution to them. So the NPLs that we have in the market and the real economy today are pretty much the same as they were a couple of years back. What has changed in the balance sheet of the banks is good, but has not solved the problem of the economy. I think it's professional servicing companies that are going to play a very positive role. The new tools and the new framework for handling them, the new bankruptcy law and the pre-bankruptcy law, is going to be helpful. And I think what my colleagues mentioned before, the need for refinancing and new liquidity coming into the market, and this is how we're going to see the resolution. And in the new liquidity, I would include as well the need for equity investment that Nikos Karamouzis described.
Well,
okay,
Stathis, if I may, I would just like to add to what George said. Not only it is the fact that we have a lot of stock to resolve and potential new flows, but I also think that we have to bear in mind when looking at the NPL sector that the banking sector is changing. And in essence, globally, what we used to see in the Greek banks and in most of the banks, that they were resolving NPLs with smaller groups within them, depending on the economic cycle. This is a change. So we do have the problem, and we do see these mega transactions and then services coming to the market. But in essence, this is also a part of the changing banking system, whereby this type of operation will not be performed in the future from the banks. So it's also a transformation of the banking system as well.
Okay. Except for that, on what Theodoros is saying, I think he's very right, but this is conditional to having a well-functioning market. And as Chris said, right now we have a hugely problematic auctions market. It's not just the absence of bidders, it's the absurdity of certain, tick the box operations, like for example, even when you have a successfully concluded auction, and in spite of the fact that there is a waterfall that pays out creditors, this will still be challenged by Social Security authorities because they want to tick off the box. That's one of the sad little details. Going back to liquidity, there's a stark difference between the Greek market and the Cypriot market, where we have transacted as well. There you have a very well functioning banking market that actually provides liquidity. There's ample liquidity and makes it easier for discounted payoff solutions. The experience here so far for us has been, I don't know, 20, 22% DPOs. In Cyprus, it's way over 50%. So this would be the critical factors that can actually, change things around.
Great. Thank you all very, very much for this extremely interesting panel. I understand we're invited to the chat room to address more questions. Thank you all very much. I can also see Nikolaos.
Yes, I reappear.
Okay, thank you. Up to you now.
Thank you to everybody. This is one of the key topics, the NPL topic. So thank you very much, Stathis, for moderating so expertly. And thank you, Christopher, Theodore, George, Nikos, and Constantine. Thank you guys very much.
Thank you. Thank you.
Bye.
Thank you. Bye-bye, guys. Good night.